Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting the market's biggest names under some serious pressure. I'm your lead analyst, and with me is our market skeptic. And today, we are putting a true titan on the anvil, Estée Lauder. You know, on the surface, it's this picture of beauty, of success. But then you look at that stock chart, it's a brutal beatdown. So we've got to figure this out. Is this just a cosmetic issue, or is there a deep crack in the foundation? Let's get right into the numbers.
Whoa, hold on. Before we even get started, let's just frame this thing correctly, okay? Because this is what matters to every single person watching right now. The company, they get up on that podium, they announce they beat expectations. Now, in any normal world, what does that mean? It means a reward, right? Green on the screen. But nope, that is not what happened here. Not even close. So the big question, the one we have to answer today, is brutally simple. They did their job on paper, so why on earth did the market drag this stock out to the woodshed? Exactly. And that's where we start. Let's build the bull case, piece by piece, starting with the numbers that management wants you to focus on. They reported earnings per share of 89 cents. Now, the street, the consensus of all those analysts paid to track this company, they were looking for 84 cents. Look, that's not just a beat, that's a statement. In a market like this, any beat is good news. But a 5-cent beat on an 84-cent expectation, that's significant. It signals real operational strength, competent execution. This is pillar number 1 for the bulls.
Okay, fine. A solid beat. A statement. Got it. Now let's look at the market's reaction to that statement. A collapse of almost 21% in one day. Folks, that is not a pullback. That's a full-blown panic. A 5-cent beat does not, I repeat, does not justify losing a fifth of the company's value overnight. This is the market screaming at the absolute top of its lungs that the headline number, that 89 cents, is a lie. Or, you know what, maybe not a lie, but it's sure as heck not the whole truth. Something underneath that so-called solid foundation is rotten, and the big money, they smelled it instantly.
And that's the conflict we are here to deconstruct. First, we are going to forge the bull case, looking at the solid operational structure they presented to Wall Street. And then we're going to expose the cracks in that armor, the numbers they kind of hide in the footnotes that completely spook the market. After that, we'll dive into Wall Street's divided verdict to see how the pros are literally fighting over this stock. And finally, we'll deliver our verdict. Is this thing an ironclad opportunity, or is it a trapdoor just waiting to spring?
All right, let's get into it. Forging the bull case. You see, to really understand why the market reacted so violently, we first have to understand the argument that Estée Lauder is fundamentally a sound company. Management laid out a very, very compelling story in their earnings release and on that conference call. It's all built on this bedrock of really strong performance metrics. So we're going to build this case from the ground up, just like they did. This is their narrative. Let's hear them out.
Okay, now look at this. Just look at this slide. It's not just about that EPS beat we already talked about. I mean, that was the headline, sure, but the real substance is right here. Revenue? It came in at $4.23 billion, just topping expectations. That's a 5.6% increase year over year. Now, for a company this big, this mature, that's solid, respectable growth. But the number that really just leaps off the page is the year-over-year EPS growth, a staggering 43%. Hold on. So you're telling me they're not just selling more stuff, they're actually making more profit on every single sale? Is that what that number really means? On an adjusted basis, yes, that is exactly what it implies. They're becoming significantly more profitable per transaction. And to top it all off, just look at organic sales, which, is a crucial metric because it strips out all the currency noise. That's up a healthy 4%. I mean, come on. This is the kind of dashboard that should make investors feel really confident. It shows strength right across the board.
And the story just gets stronger when you actually listen to the conference call. Look, they didn't just report good numbers. They painted this picture of powerful forward momentum. First off, they raised their sales outlook for fiscal 2026. I mean, that's a huge sign of confidence. Then they highlighted double-digit growth in Mainland China, a critical market that a lot of analysts thought was really slowing down for luxury goods. And their digital channels? They're on fire, now making up over 31% of their entire sales mix. On top of that, they're accelerating innovation, targeting a full 25% of all sales to come from new products. Okay, but what about this Beauty Reimagined plan? I mean, it sounds great, but come on, we hear these corporate turnaround names all the time. Is that just more corporate jargon they cooked up in a boardroom, or is it actually delivering real results? Well, according to them, it's making very tangible progress. They hammered that point home again and again. From their perspective, this is the story of a company that is just firing on all cylinders.
And look, this isn't just internal spin. The financial media, they picked up the exact same narrative.
Reuters reported on the confidence that was just radiating from the executive team, and they directly linked it to the turnaround progress and that improved sales forecast. Now, when a respected, neutral outlet like Reuters amplifies your story, well, that lends a tremendous amount of credibility. So you see, the bull case wasn't just presented, it was being validated by outside parties. On the surface, everything looks solid as a rock. And this right here is the capstone, the final crowning piece of the bullish structure, the raised full-year guidance for fiscal 2026 earnings per share. They are literally telling the market to expect somewhere between $2.05 and $2.25 per share. You know, raising guidance is one of the most powerful bullish signals a management team can possibly send. It's a direct message. It says, hey, not only was the last quarter good, but we are so confident in our business that we are officially telling you the future is even better. This is the structure they built for Wall Street, an impenetrable fortress of good news. Okay, I've heard the sales pitch. It's polished, it's compelling, and you know what? It's exactly what you'd expect from a premier beauty brand. But the market didn't buy it. Not for a second. A 21% drop tells you that investors took a sledgehammer to that pristine facade and they found some serious cracks in the foundation. It is time to stop looking at the glossy brochure and start looking at the fine print, because that, my friends, is where the real story is hiding. All right, let's start with the first bombshell, $904 million. That's right, over $900 million. That is the cumulative cost of their so-called Beauty Reimagined turnaround. So while they're on the conference call, talking about their great adjusted earnings, nearly $1 billion has been spent on these restructuring charges, which, so conveniently, get stripped right out of that headline EPS number. So the market sees this and it asks a very simple, very brutal question. How profitable are you really if it costs you this much just to get your house in order? That's not profit, that's a ridiculously expensive renovation. And it gets worse. On top of those massive internal costs, they dropped another bomb on that same conference call, a $100 million headwind from tariffs. Now, this isn't some internal project. This is an external pressure that directly attacks their margins. This is $100 million in profit that is just going to vanish, mostly in the second half of the year. So think about that. While they're raising their guidance with one hand, they're telling you with the other that a massive, totally unavoidable cost is coming right at them. This completely undermines that entire confident forecast they just spent all that time laying out. And this slide right here, this just perfectly illustrates the deception, the two realities. On the left, you've got the number they want you to see, the adjusted operating income of $608 million. That's the number they talk about in the press release, the pretty one. But on the right, you have the real number, the GAAP number, generally accepted accounting principles, after you account for all those charges we just talked about, $401 million. That is a $200 million gap between their story and reality. I mean, Barron's pointed out that the restructuring wiped out roughly half the quarterly profit. The market looked at this and said, you know what? We don't believe in the adjusted fantasy, we believe in the reported reality. And the reality is a much, much, much less profitable company. Okay, so let's drill down even further. Let's get into the balance sheet and run a real stress test on the actual financial durability of this company. First, the net margin is negative 6.44%. Let me just repeat that. After all is said and done, they are losing money. Next, the debt-to-equity ratio, 1.88. That is a heavy, heavy debt load. It means they have almost twice as much debt as they have equity. In a high-interest rate environment like we're in now, that is a serious risk. Then you have the price-to-earnings ratio, which is negative because, well, there are no net earnings to measure. And finally, the quick ratio is 0.92. Here at Iron Financial, we watch this one very, very closely. Anything below 1.0 is a big red flag. It means if they had to pay all their current bills tomorrow with their most liquid assets, they couldn't do it. This is not the financial profile of a fortress. This is the profile of a company under some significant financial strain. Okay, you've laid out the bear case, and I have to admit, it's formidable. Those financial metrics are undeniable weaknesses that directly challenge the entire bull narrative we built. So what we have here is an incredibly conflicted picture. You have this real operational momentum, the growth in China, the digital strength, and it's clashing directly with severe financial fragility. This is not a simple good news or bad news story. This is a war between two opposing realities. And that war is being fought right now, as we speak, in research notes and on the trading desks all over Wall Street. And let's look at the evidence of this conflict. This donut chart here shows the breakdown of professional analyst ratings. The single largest group, with 11 analysts, is hold. Now, that is the textbook definition of uncertainty. It's basically Wall Street shrugging its shoulders and saying, we have no idea. But look closer at the distribution. This is not a consensus at all. You have 13 analysts over here screaming to buy the stock, 10 buys and 3 strong buys. They see that operational story we talked about. But then on the other side, you have 4 telling you to sell, including 1 strong sell. They see the balance sheet risk. This is a house divided against itself. The professionals literally cannot agree on what this company is worth.
And it's not just some general disagreement. The divergence here is extreme. I mean, you have one of the biggest, most respected names in all of finance, Goldman Sachs, looking at all this same data, and they're upgrading the stock to a buy, slapping a $115 price target on it. They are pounding the table telling everyone to buy. But then, on the complete opposite end of the spectrum, you have another respected firm, Rothschild Reb, looking at the exact same data and issuing a strong sell. This is what a true battleground stock looks like, folks. The bulls and the bears are dug deep into their trenches, and there is absolutely no middle ground in sight.
Now let's look at the smart money. And honestly, this might be the most fascinating piece of the entire puzzle. On one side, you have the insiders, the directors and vice presidents, the people who walk the halls of the company every single day. And what are they doing? They are selling. As you can see on the left, Director Barry Sternlicht sold nearly 4,000 shares. VP Meredith Webster sold over 5,400. That's a classic bearish signal. But then you look at the other side, the massive billion-dollar institutions, and they are buying with both fists. Wellington Management increased their position by nearly 4,000%, Franklin Resources by almost 1,200%. Okay, so wait a minute. Let me get this straight. The people on the inside, the ones who know the company best, are getting out, while the big money on the outside is rushing in? What in the world do they see that the insiders don't?
And we're not talking about token purchases here, just to diversify a portfolio. No, these are colossal bets on the company's future. Wellington now holds over 2 million shares. Franklin Resources holds over 1.5 million. And look at the new players entering the game. Two Sigma and Zurich Insurance Group, they both established massive new positions worth over $50 million apiece. In total, institutional investors now own over 55% of the company's stock. Now, these are not emotional, retail-driven decisions. This is calculated, long-term capital placement. These giants are looking right past the short-term pain, past the restructuring costs and the tariffs, and they are betting that the operational engine is ultimately going to create immense value from these beaten-down prices. So that brings us to the final stress test. We have a bull case built on a seemingly solid operational foundation. We're talking growth, guidance, and powerful brands. And we have a bear case built on severe financial weaknesses, charges, debt, and negative profits. The insiders are selling, the institutions are buying, and Wall Street is at war with itself. It's time for us to weigh all the evidence and deliver the iron financial verdict.
Yeah, that's the bottom line, isn't it? After you strip away all the beautiful marketing and the scary headlines, you're left with one single question that every investor has to answer for themselves. Is the underlying structure of this company actually sound? Or did that 21% collapse reveal a fundamental flaw that could lead to a total demolition? Is this a renovation, or is it a ruin?
Okay, let's put it all on the table, side by side. The bull case is clear, a strong Q2 beat on both earnings and revenue. They raised their sales outlook for fiscal 26. They have real momentum in China and digital, the growth engines of the future. And critically, the biggest players on Wall Street, the institutions, they are loading up on the stock. But the bear case is just as powerful, if not more so. We're talking nearly $1 billion in restructuring charges that are just destroying reported profits. $100 million in tariffs are coming for their future margins. The company right now is not profitable, with a negative net margin. And the balance sheet is loaded with debt, while the insiders, the people who know the most, are selling their shares. You can't ignore that.
Okay? Here at Iron Financial, our job is to determine if a structure is sound enough to withstand market pressure. After running all the numbers, what we see is a company in the middle of a very painful but probably necessary renovation. The market is reacting, and reacting correctly, to the enormous cost in the mess of this renovation. The restructuring charges, the tariffs, the negative reported earnings, that's the bear case, and it's all short-term. The bull case, however, is built on the strength of the underlying operation and the conviction of long-term institutional capital. So our verdict is this. The market has overreacted to the demolition phase of the turnaround, and it's ignoring the strength of the new foundation that's being poured. The operational metrics and that massive institutional buying, those are forward-looking indicators. They suggest that the long-term earning power of this company is being rebuilt, not destroyed. We believe the fear is temporary, the franchise is permanent.
So that's our analysis. We see a clear disconnect between the short-term pain and the long-term potential. But as always, the final decision rests with you and your portfolio. Do you believe the institutional giants are right and that this is a rare chance to buy a world-class brand while it's still covered in construction dust? Or do you believe the insiders and that shaky balance sheet are sounding an alarm about deeper structural problems that just haven't been revealed yet? So the question for you is this: is the market's fear your opportunity, or is it a warning you simply can't afford to ignore? Run your own stress test. Thank you for joining us at Iron Financial.